$5,000. When you see a number like that, especially from the world's biggest banks, the first thought is speculation, right? But what if it's not? What if it's actually preparation? The real question we're going to unpack here is how these major institutions even arrived at this number. And spoiler alert, it's not about predicting the future. It's about reading the present correctly. Right, so let's get into this. This isn't some forecast that comes from staring at charts all day. It comes from understanding these really deep structural signals inside the global financial system. The kind of signals that most of us are actually trained to ignore until it's way too late. Gold's value isn't about how shiny it is. It's a barometer for our confidence in the entire system. And right now, that barometer is pointing down. And welcome to Bullion Signal. Our entire mission here is to help you find that signal in all the noise of global finance. We focus on clear institutional-grade analysis to help make sense of these huge shifts. If that sounds like what you're looking for, go ahead and subscribe so you don't miss any of our ongoing coverage. So, here's the game plan for this explainer. We're going to build this case for you piece by piece. First, we'll look at the big macro storm that's brewing right now. Then, we're going to break down the 4 key pillars that support this whole idea. We'll even touch on how to read the hidden signals for yourself before we wrap it all up and explain why this isn't just a possibility, it's a milestone. Okay, let's start with the 30,000-foot view. The global economy, and especially its central banks, are just getting squeezed from all sides. And this isn't your typical economic cycle. What we have is a perfect storm of massive government debt, inflation that just won't quit, and geopolitical tensions all converging to create a really unstable environment. And at the very heart of this storm is something we call the Fed's trap. Think about it. They have a choice, but it's a brutal one. If they cut interest rates to save the economy, they risk letting inflation roar back to life. But if they keep rates high to fight inflation, they could easily push us into a deep recession. There's no easy way out of this, That whole soft landing idea, it's pretty much off the table when the ground itself is this unstable. Now, here's what's so fascinating. We've seen this movie before. History gives us 2 really clear examples. After the US cut the dollar's link to gold back in '71, what happened? Gold just exploded as faith in the system crumbled. And we saw a similar thing happen after years of aggressive rate cuts in the 2000s led to the '08 crisis. The pattern is always the same. When there's a deep loss of faith in the currency system, that's the trigger. Okay, so with all that as our backdrop, let's get to the core of the argument. We're going to build this case on 4 pillars. And it's so important to understand that these aren't just 4 separate ideas floating around. They're all connected. They're all part of this massive structural shift that's already happening in the global monetary system. So our first pillar is the most straightforward one, really, because it's just pure math. It's the inescapable sovereign debt trap. And this isn't about politics or some economic theory. It's a numerical reality that has direct, unavoidable consequences for the entire global financial world. Just look at that number. The U.S. national debt is now over $36 trillion. But honestly, the static number isn't even the scary part. It's the speed. This number is growing by about $2 trillion every single year. At that pace, the debt just becomes this self-feeding monster that might be mathematically impossible to solve with the usual tools. And this is where you see the consequences starting to bite. Foreign central banks, who used to be the biggest buyers of U.S. debt, are now slowing down. And why wouldn't they? They're looking at a political system that can't seem to agree on how to control its spending. So when that trust in a government's promise starts to fade, all that capital has to find a new, neutral home, an asset that doesn't depend on those promises. Which leads us to our first big question, and I'm really curious to see what you all think down in the comments. This isn't just some academic thought experiment. This is a real practical problem for global markets right now. When the world's traditional safe haven asset, US government bonds, starts to look risky, where does all that money go for real safety? All right, let's move on to our second pillar because it builds directly on that last point. While investors are out there debating this problem, the most informed institutions on the planet, the central banks themselves, are already moving. And trust me, their actions speak so much louder than any press conference ever will. This chart says it all, really. For the last couple of years, central banks have been buying over 1,000 tons of gold annually. That is more than double the average of the entire previous decade. We have to be really clear here. This isn't just diversification. This is a fundamental repositioning for a very, very different financial future. And what's more, this is happening all over the world. China has been adding gold to its reserves every single month for over a year. Countries like Turkey, Poland, and India are doing the same. It's a clear move away from the US dollar, and it's a signal that our growing bullion signal community is watching very closely right along with us. So the key takeaway is this. To steal a line from institutional analysis, this isn't just them rebalancing their portfolios. This is strategic repositioning. These central banks are getting their balance sheets ready for a future where the current monetary system just isn't a given anymore. They're laying a new foundation for whatever is coming next. This leads us to pillar number 3, which is all about connecting that big macro picture to a specific industry. It's so important to understand how a rising gold price creates this massive leveraged effect on the profits of mining companies. It all starts with something called the all-in sustaining cost, which is basically just what it costs them to get 1 ounce of gold out of the ground. This concept is everything when you're talking about institutional money. So let's use some real numbers to get a baseline. The average all-in cost for a miner is around $1,600 an ounce. With gold trading around $2,400 recently, they're already making some great profit margins. That's about $800 of pure profit for every single ounce they pull from the earth. That's a pretty healthy business model. Now watch what happens when we hit that $5,000 milestone. If gold moves from $2,400 to $5,000, that's about a 108% increase. The miner's profits per ounce jump from $800 to $3,400. That's a 325% increase in profitability. See? Their costs stay about the same, so all that new revenue goes straight to the bottom line. That is pure leverage. And that's really the main point here. The stocks of these mining companies don't just follow gold. They are designed to amplify its moves because their profit margins expand exponentially. This is exactly why the smart money often flows into the mining sector during a gold bull market. It's how they can get magnified exposure and potentially outperform the metal itself. Okay, our final pillar is the most fundamental one of all. This isn't about charts or numbers or profits. It's about the very foundation of our entire financial system, confidence. And when that confidence starts to fracture, like it is right now, capital just instinctively looks for something that doesn't rely on it. This slide really just lays it all out in black and white. The current US dollar system has been the world's anchor for about 50 years, and it's backed by promises and policy. Gold, on the other hand, has been money for over 5,000 years, and it's backed by physical reality. So as the system of promises gets stressed by debt and inflation, well, the appeal of physical reality just naturally gets stronger. And this is why it's so crucial to think about gold in a different way. It's not an investment in the traditional sense, something you hold for a nice return. It's insurance. It's an asset you hold as protection against the failure of all the other financial assets we depend on. And right now, the market is starting to price in the odds of that failure, whether most people see it yet or not. So, there you have it. We've laid out the historical pattern. We've walked through the 4 pillars: the debt, the central bank buying, the miner leverage, and the fracture of trust. that are all pushing this structural shift forward today. We've covered the why. So that brings us to the next logical question, which is, what do we do about it? And that is exactly what we're going to cover in part 2 of this analysis. We're going to shift from the why to the how. We'll give you a practical framework for reading these hidden market signals and for understanding why that $5,000 level isn't just a forecast, it's an inevitable milestone. So make sure you're subscribed with notifications turned on because you are not going to want to miss it.